Hi, I'm Sharon Kreider. I'm here in the Western CPE studio in Bozeman, Montana, and we're going to look at questions and answers that have come in from our webcast viewers on day one, the individual day of our webcast. What's the due date for an entirely employer-funded plan? So for an entirely employer-funded plan, the due date for originating the plan is the due date of the tax return now. That's a change. It was by December 31st of the year that you want the plan to be in effect. Now, as a good change for us, because we'll have a better idea what taxable income is for the particular year, the employer-funded plan, and that might be their defined benefit plan or their defined contribution plan. It is an entirely employer-funded plan. Now, what about a 401k? Well, that's not an entirely employer-funded plan because it has elective deferrals. It has different origination dates than I have for my defined contribution or defined benefit plan. A taxpayer has made a Roth IRA conversion from a traditional IRA in 2018, 2019, and again in 2020. Does each conversion have its own 5-year holding period, or does the first conversion in 2008 start the 5-year timeline? Each conversion has its own 5-year period. If you converted your traditional IRA to a Roth IRA in 2018, the 5-year period for those converted assets began on January 1st, 2018. If you later convert more traditional IRA assets to a Roth IRA in 2019, the 5-year period for those assets begins January 1st, 2019. Is there an age limit for solo 401k contributions for the owner of a Schedule C, for the sole proprietor reporting on a Schedule C? And a second question came in. Can a 73-year-old still working contribute to a Roth IRA? The only age limit on contributions to a retirement plan was regarding an IRA, and that age limit, was removed by the Secure Act. So there is no age limit for the sole owner of the Schedule C contributing to a pension plan, and there is no limit for a working 73-year-old on contributing to a Roth IRA, other than our normal limits on that Roth IRA on income limitations for them. Our 401k and Roth IRA contributions, the 401k and the Roth IRA account both protected from creditor claims. 401ks are considered qualified retirement plans by ERISA, so they are protected from creditor claims in bankruptcy. IRAs and Roth IRAs are not protected by ERISA, but they are protected to an amount of approximately $1.3 million. It's adjusted for inflation. It's slightly over that. But remember that the courts have said in a couple of cases that inherited IRAs are not protected from creditor claims. Let's see a few questions that have come in on real estate. Thank you. I'm Sharon Kreider at Western CPE.